Welcome back to the deep dive. Today, we are strapping in for a quarter-century retrospective that feels incredibly timely. If you've been paying any attention to the technology sector, you've likely felt that familiar twitch of market anxiety.
Oh, yeah.
Is this current AI boom with its staggering valuations and explosive growth, is it just the 2000 dot-com bubble all over again?
It is the comparison.
Yeah.
I mean, it absolutely dominates investor chatter, and you can't ignore the surface-level similarities, right?
Right.
We are looking at massive, rapidly appreciating valuations, and they're tied to a genuinely transformative technology.
Yeah.
It was the internet then, generative AI now.
And those similarities, they make investors nervous,
Yeah.
especially anyone who, lived through the last bust.
Understandably nervous, yeah.
So we have to start with the historical benchmark, the moment the fever truly broke. We're talking about March 10th, 2000. That's the day the technology-heavy and NASDAQ Composite Index peaked at 5,048.62.
And that was after having more than double its value in just 12 short months.
Just 1 year. It was the absolute height of pure, unadulterated speculative frenzy.
That day really did represent a historic climax of optimism. So our core mission today, then, is to move beyond those superficial comparisons.
Okay.
We have to first, deeply understand the mechanisms that drove the dot-com era, the specific failures that caused that eventual catastrophic crash.
Yeah.
And then, and this is the crucial part, analyze the structural shifts.
What's actually changed in the architecture of the market?
Exactly. What are the specific changes that today's leading investors and financial experts say make the current environment fundamentally architecturally different?
So this isn't just about comparing the business plans of, say, Pets.com to OpenAI.
No, not at all.
We're digging into the foundational architecture of the capital markets themselves. How is money raised? Who is holding the risk? And, what are the actual balance sheets backing all this innovation?
That distinction is absolutely key. We're turning to insights from experts like Professor Karong Shao, a finance professor at Columbia Business School.
Right.
And he readily acknowledges the psychological and emotional similarities that, cause that investor anxiety, that feeling of a gold rush. But his immediate critical distinction is this. If the moment we are in right now does end up bursting, the structure of the market means the dynamics and the consequences will look fundamentally different than they did in 2000.
That sets up our core tension perfectly. We need to dissect whether this is simply history repeating itself, a new wave of irrational exuberance, or if this time the financial structure is truly demonstrably different, providing a far sturdier foundation.
Yeah.
Okay, let's unpack this by first revisiting the past.
Yeah.
So to truly appreciate the alleged strength of the current foundation, we really have to deeply appreciate the scale and, let's be honest, the sheer absurdity of the disaster a quarter century ago.
Exactly. We need to define the bubble not just by its peak, but by its underlying pathology.
Right.
The dot-com era, spanning roughly 1995 to that infamous 2000 peak, was characterized by a rapid, utterly unsustainable increase in the valuation of any company.
Any company.
No matter how tenuous its business plan. That attached .com to its name. These were internet service and technology companies that often had minimal or, zero records of profitability.
The enthusiasm for the World Wide Web was electric. And, in some ways, it was justified by the long-term reality of what the internet would become.
Oh, absolutely. The vision wasn't entirely wrong.
But the short-term financial model was, well, it was entirely unfounded.
The numbers that showcase that growth frenzy, they remain staggering. The NASDAQ index, which, tracks the overall value of outstanding shares on that exchange, it rose nearly sevenfold in just 5 years.
Sevenfold.
Yeah, from just 743 in 1995 to the peak of 5,048 by March 2000. It wasn't organic growth based on increasing profits. It was exponential growth fueled purely by projected future excitement.
Okay, so if the underlying growth wasn't there, what were the root causes that allowed that level of inflation to happen? It wasn't just a few bad stocks. It felt like a systemic breakdown in financial discipline.
It was a collective lapse in discipline, absolutely. And it was fueled by a perfect storm of factors. The first one was simple: euphoria and overvaluation. The newness of the internet led investors to completely abandon traditional financial metrics. They just stopped looking at core concepts like revenue, profit, or actual generated cash flow.
So what were they looking at instead?
Companies were valued purely on metrics like eyeballs, page views, or just future potential. If a company could claim they had a novel way to leverage the internet, they got funded, period.
It sounds utterly illogical now, but at the time, there was this genuine, powerful cultural belief that the internet had fundamentally changed the rules of capitalism,
It did.
that this new economy meant profits didn't matter yet.
That belief was amplified by our second critical cause, the capital flood. This was a period of abundant venture capital, and crucially, it was coupled with an environment of historically low interest rates.
Ah, okay. The Fed.
Yeah. The Federal Reserve had cut rates after the Asian financial crisis and the long-term capital management collapse in 1998, which created an environment of easy, cheap money. This capital needed a place to go, and it flooded the tech sector.
And when you say flooded, we have to look at the scale. Our sources point out that by 1999, an almost unbelievable 39% of all venture capital investments were pouring into internet companies.
39%. Nearly 40% of all available high-risk venture capital was concentrating into a single, highly speculative sector.
And often chasing identical or just very slightly differentiated business models.
Which leads directly to the core psychological failure, right? This idea of irrational exuberance.
That famous phrase, yeah. Initially attributed to then Federal Reserve Chair Alan Greenspan, and it perfectly captured the investor overconfidence.
It really did.
It was this widespread, almost dogmatic belief that traditional valuation methods, balance sheets, income statements, profitability were just irrelevant in this new economy.
So they were just ignoring the red flags, completely ignoring the debt-ridden companies that were structurally incapable of turning a profit. They were convinced that just being first or biggest was enough to guarantee success, regardless of the cost.
And the companies themselves were operating under this get big fast mentality.
Yes.
They were just racing for market share and brand awareness at literally any cost because they knew cheap capital was always available.
And that mentality meant fiscal responsibility was, well, it was a joke. They engaged in massive spending on advertising, branding, and promotions.
Right, the Super Bowl ads.
Think of the Super Bowl ads paid for by companies that wouldn't see a dime of profit for a decade, if ever. Some startups, our research shows, spend as much as 90% of their entire budget just on marketing.
90%.
Just to establish a brand and stand apart from the hundreds of identical competitors. They were pure cash burn machines.
You can just imagine the sheer reckless waste. We're talking about companies like Webvan.
Oh, Webvan.
They built these massive, expensive refrigerated warehouses and fleets of delivery trucks, convinced that groceries needed to be delivered immediately, regardless of the staggering logistics cost.
Webvan is just a chilling example of operational arrogance. They raised over $800 million.
Wow.
And they lasted only 18 months after they launched. And of course, who could forget Pets.com?
The sock puppet.
The sock puppet. They spend a fortune on their mascot and brand awareness, delivering heavy bags of dog food, often at a loss, before folding in 2000. It was a race to the bottom, funded by speculative money.
So we have this structure of emotional excitement, cheap, easy money, and absolutely no fiscal discipline. I mean, when you look at the financials now, it seems so obvious it would collapse. But what was the actual trigger?
The trigger was external and monetary. It cut off the lifeblood of that cheap capital. In early 2000, the Federal Reserve, concerned about rising inflation, raised interest rates.
A classic move.
A classic maneuver. But its immediate amplified effect was to reduce the availability of that abundant, cheap capital and signal reduced liquidity in the financial system.
And that tiny crack of reduced liquidity was enough to expose the rotten core of all those overvalued, profitless companies the moment the music stopped.
All those cash burn models just collapsed.
Yeah.
Exactly. The lack of a strong business model meant that the instant capital started to dry up. There was no backup plan. The panic truly started when established, supposedly safe high-tech companies like Dell and Cisco placed huge sell orders on their own stocks.
No, that's a bad sign.
It signaled to the rest of the market that the foundation was truly compromised, and that sparked a widespread, devastating panic.
Okay, now let's look at the actual crash metrics, because this is where the long-term pain of 2000 becomes frighteningly clear.
It's brutal.
The NASDAQ index plummeted an absolutely staggering 76.81% from its March 2000 peak of 5,048 to its low point in October 2002 at 11,139.90.
Trillions of dollars in investment capital just evaporated. And not just from the failures like Webvan and Boo.com, but from the survivors, too.
Right.
Companies that went on to become giants still suffered immense, years-long destruction of value. Cisco, Intel, Oracle, the backbone of the internet infrastructure, saw their stock prices erode by over 80%.
Over 80%. Think about the societal cost of that. If you were a mid-career professional with your retirement heavily weighted in tech stocks or 401ks, you were just crushed.
Completely wiped out.
Even if you bet on the right companies that survived, the pain was immense. And Microsoft is the perfect, chilling example of that prolonged misery.
Microsoft's journey is so essential for context. Its stock dropped about 60% during the initial crash phase, but by its post-crash low point in early 2009, and that was following the financial crisis, which just accelerated existing tech weakness, the stock was down over 74% from its 2000 peak.
And the recovery wasn't fast. It wasn't a V-shape. It was agonizingly slow.
So slow.
The Nasdaq took 15 years, a generation, until April 2015, just to reclaim the peak it had hit back in 2000.
And Microsoft itself didn't fully recover its pre-crash valuation until 2016.
Yeah.
That prolonged, painful recovery period is the reason why investors are so exquisitely sensitive to the comparisons today.
Of course.
The market was thoroughly contaminated by bad bets, and cleaning that up took a decade and a half of stagnant growth.
That depth of historical memory is the fear we are wrestling with. So let's take that history and pivot to today. If we are standing on the edge of another technological revolution, where does the financial structure differ, and why should we be, maybe less worried about a 15-year recovery?
Okay, so the single biggest defense against the "it's 2000 again" argument revolves entirely around structural differences in how capital is deployed and, crucially, who is allowed to take the risks.
Right.
We have moved from what you could call the IPO gold rush to what Professor Zhao calls the private fortress.
Walk us through the mechanics of that change, because in 2000, if you had an idea, you wanted to go public immediately via an IPO.
Immediately.
Now, the goal seems to be to stay private for as long as humanly possible, even at multi-billion-dollar valuations.
That's the core shift. In 2000, the frenzy was really triggered by the 1995 Netscape IPO, which became the signal for a gold rush. Hundreds of internet startups rushed to the Nasdaq, trying to raise enormous amounts of capital quickly from the public retail market.
Because they needed that cash to sustain the get big fast strategy.
Exactly. You had to go public fast, often before you had a coherent business model, just to survive the intense cash burn competition.
Okay.
Today, the capital formation model is fundamentally different, and this shift is due to both economic trends and regulatory changes. New investment capital is channeled predominantly through the private equity and venture capital markets.
What specifically changed on the regulatory side to make public markets so much less attractive for these early-stage companies?
Well, the fallout from the 2000 collapse led to major legislation aimed at protecting public investors. The big one was the Sarbanes-Oxley Act of 2002. SOX, yeah. It dramatically increased the administrative, legal, and compliance costs for a company to go and stay public. And for a nascent startup, these costs were just prohibitive.
So compliance costs made the IPO route much more expensive and complex for these small companies.
Precisely. And furthermore, the definition of an accredited investor, the sophisticated people allowed to participate in private financing rounds, that evolved, allowing private companies to raise vast sums from institutions, hedge funds, and high net worth individuals.
All without ever needing to face the general public.
Or the intense scrutiny of a quarterly earnings report.
And we see this played out perfectly with the biggest names in the AI revolution today.
Correct. Today's most prominent, highly valued AI developers, you've got OpenAI with its Microsoft partnership and Anthropic, backed by Amazon and Google. They remain fiercely private. They've achieved valuations already in the tens of billions of dollars, sometimes over $80 or $90 billion, all while remaining outside the public market.
Which means they are accessing these vast pools of capital needed to drive this hypergrowth, the compute chips, the talent, without having to face the same volatility or public scrutiny that crushed the dot-coms.
It creates a crucial buffer. The risk of these speculative, high-growth, high-valuation firms is concentrated among sophisticated institutional investors who can stomach the risk and are locked in for longer periods.
So they don't have to deal with the inherent volatility and emotional swings of retail investors reacting to a disappointing quarter.
Exactly. And this shift has a huge impact on volatility concentration, doesn't it? In 2000, the instability was spread across hundreds of small, cash-strapped public companies. If one failed, the entire sector wobbled and the Nasdaq just plummeted.
Right.
Today, the concentration of the initial technological risk is, it's contained. And the rest of the tech wave, the commercialization and infrastructure build-out, is channeled through established, cash-rich giants. This is the Mag 7 we'll discuss in depth.
Microsoft, Google, NVIDIA, Meta.
All of them. They are the incumbents. They're the ones spending the most money on AI, and they provide a massive financial cushion against systemic market volatility that the dot-com era simply did not possess.
It's almost like a system of controlled speculation. The highest risk is concentrated in the private sphere, while the public market infrastructure is backed by these established companies with real, existing revenue streams.
It reinforces Professor Xiao's point perfectly. He says, the big companies can survive if there's a crash in the market because they have other ways to raise financing, whereas the small guys get eliminated. The risk of that system-wide trillions of dollars evaporation is mitigated because the largest players can absorb shocks, unlike the ecosystem of weak, cash-burning public companies in 2000.
Let's move to the most compelling tangible difference then, the financial health. In 2000, we had companies valued in the billions with minimal or zero revenue, essentially operating on a debt-fueled prayer. What do the balance sheets of today's AI leaders look like?
They look fundamentally different, fundamentally healthy, and overwhelmingly profitable. This is what we're calling the hyperscaler advantage.
Okay.
If we compare the 2000 predecessors, those freshly minted startups relying on aggressive marketing spend, to today's incumbents, the financial reality is night and day. AI innovation is being funded by tech giants with incredibly diverse global revenue streams and substantial, verifiable profits.
So the innovation isn't running on speculation, it's happening on top of a massive accumulated pile of existing free cash flow.
Precisely. And we should explicitly define the group driving this. We're focusing largely on what the market calls the Magnificent Seven, or Mag 7,
Right.
a small group of hyper-dominant tech companies. Apple, Microsoft, Alphabet, which is Google, Amazon, NVIDIA, Meta, and Tesla. They command a colossal share of the total market capitalization.
And it's the sheer financial firepower of these specific companies that underpins the entire AI revolution, right?
Absolutely. Major investors like Philippe Lafond of Coatue Management and Bill Ford of General Atlantic remain fundamentally bullish for this exact reason. Ford states clearly that the people driving change in AI are these large public incumbents.
And their capital isn't cheap VC money, it's operational profit.
Yes.
I found Lafond's assessment of the financial health of the Mag 7 to be the most shocking contrast to the year 2000. I mean, that zero debt metric is the key.
It is the absolute killer distinction. Lafond highlights that these biggest publicly traded tech companies are currently on their way to producing close to $1 trillion of free cash flow annually.
$1 trillion.
$1 trillion. That is cash generated after all operational costs and necessary capital expenditures are paid for, and they are doing this with no significant debt.
$1 trillion in free cash flow annually, and they owe virtually nothing. This changes the risk profile completely.
It means they don't have creditors breathing down their necks, demanding repayment during a downturn. Lafont notes that most companies producing free cash flow elsewhere in the market are doing so with a ton of debt, which severely restricts their ability to invest and adapt during tough times. But the top tech companies have balance sheets that are pretty healthy, and the implied leverage in the system is small.
So this means that the massive scale of investment we are seeing. Wall Street estimates these companies may collectively invest over $500 billion in AI bets next year. This is highly capital disciplined.
It is capital they actually possess. These are investments made by companies with established boards, tested management teams, and rigorous return on capital requirements.
Right.
They aren't just throwing money into the void hoping for clicks, like the dot-coms. They are funding infrastructure, data centers, chips, research, to secure a foundational position in what they believe will be a massive, long-term revenue driver.
That fundamentally challenges the idea that the Magnificent Seven valuations are pure speculation, even if they appear historically high.
And Bill Ford addresses that valuation point directly. He says the amazing thing about valuation increases among the Mag 7 is the earnings follow-through. This is not double to triple price-to-earnings ratio. The earnings are there.
So the profits are demonstrably substantiating the price increases.
They are. It's a structural break from the 2000 model, where the stock price was sometimes 50 times the revenue, and the revenue itself was still mostly theoretical.
The profits are real, the cash is real, and the capacity to absorb risk is vast. And we have a great recent example of this stability and quick turnaround in the context of the incumbents, the story of Google Alphabet.
Yes, the Google Alphabet story illustrates how quickly the AI narrative can shift for the better when you have those massive underlying financial fundamentals. Not long ago, in the immediate wake of ChatGPT's debut, Alphabet was seen by some investors as having lost the critical early momentum in the AI war.
Yeah, I remember that. There was skepticism about their ability to respond to OpenAI and Microsoft.
A lot of skepticism. Yet within a year, they engineered a stunning reversal, deploying new models and integrating AI across their entire ecosystem.
And the stock responded.
Exactly. Alphabet quickly became one of the best performing big tech stocks of the year. This recovery story highlights investor confidence in their ability to weather short-term competitive threats. And that confidence was cemented by a highly notable investment revelation. Warren Buffett's Berkshire Hathaway revealed it had taken a substantial stake in Alphabet.
And that, coming from a firm known for deeply valuing fundamentals and long-term viability, is a huge sign of confidence. What does that signal to the average investor who might feel they missed the initial boom?
It tells them that even the most conservative, fundamentals-focused heavyweights see real, long-term value in the underlying business.
It's pretty ironic, given Buffett's own history with Google.
It is. At the 2019 Berkshire meeting, he and Charlie Munger lamented that they had screwed up by not buying Alphabet earlier when shares were around $59.
And now they're what, over $270?
It's significantly higher, yes. Yet Berkshire Hathaway still saw substantial long-term value in buying a significant stake. This demonstrates that for the financial heavyweights, the underlying business is robust, and the potential application of AI is worth buying into even after significant appreciation.
So they perceive the risk floor as being very high, given the cash reserves.
Exactly.
So the argument here is simple. Where 2000 was built on a pyramid of debt-fueled hope, 2024 is built on a fortress of debt-free cash flow.
While the balance sheets are certainly different, we do have to acknowledge that some bubble fears persist. We still see tremendous volatility, like the NASDAQ recently ending a strong run of gains. Even with strong earnings, investor psychology remains, fragile.
It does. But major investors like JP Morgan's Mary Callahan Erdoes emphasize the need to focus on genuine opportunities rather than allowing the market to be paralyzed by the historical bubble question. And Bill Ford noted that General Atlantic is aggressively investing in AI across all 200 of its portfolio companies, and they are already seeing a pretty high payback.
In what kind of areas?
In application areas like customer care, coding, and digital marketing.
So they aren't treating this as a speculative exposure. They are treating it as an essential competitive investment, a fundamental efficiency driver.
Right.
And this leads us to what is perhaps the most intellectually interesting argument about why this time is fundamentally different: the unique economics of AI itself.
What's fascinating here is Philippe Lafont's economic argument. It directly addresses the potential for commoditization. The fear that as AI models become more efficient and cheaper to run, the value of the underlying compute and services will inevitably drop to zero, like any commodity.
Lafont acknowledges that the price, let's call it P of a compute token, which is the fundamental operational component of AI, will likely go down dramatically due to hardware advancements.
Okay.
In a traditional commodities trap, when the price falls, people only buy marginally more, and the total revenue earned by the seller, P times Q, stagnates or declines.
But he argues that AI is fundamentally different from a traditional commodity, like oil or corn, where demand is relatively fixed. He does not see a market that goes to zero.
Right.
Why not?
He argues that while the price may go down dramatically, the elasticity of the things we can do, which is Q, or quantity and demand, is almost infinite. He uses this fantastic analogy. It's like gasoline to an engine.
Okay, explain that gasoline analogy in more detail.
Well, think about it. If gasoline prices drop by half, you might drive your car a little more, but you won't suddenly start driving 10 times as much.
Right.
That demand is inelastic.
Right, there's a limit to how much I can drive.
Exactly. In AI, Lafont argues, the demand is almost boundlessly elastic. If the cost of running a sophisticated AI drops from $1 to a penny, the number of new computationally intensive tasks, we can suddenly apply that AI to the queue is so vast and so new.
Like what?
Self-driving cars, drug discovery, personalized education. The overall market size still grows strongly because of these new applications.
So his theory is that even if P trends towards zero, P times Q, the total output and value generated by utilizing that cheap compute, can go to near infinity. The explosion in demand for new applications dramatically outweighs the reduction in cost per unit.
He is highly optimistic that for a very long period, perhaps a decade plus, any decrease in the price of the token will be dramatically offset by the explosion of new, unforeseen uses. And this isn't just software. It includes the physical world. He mentions cars, humanoids, and advanced manufacturing machinery, all driven by AI.
That is an argument based on fundamentally unlimited human demand for ever-increasing intelligent computation. It relies on the belief that once something becomes cheaper, we find exponentially more uses for it.
And that belief is what drives the current investment cycle. It connects directly to the idea that these hyperscalers are involved in a circular AI economy.
Explain that.
They are investing massive sums into chip makers like NVIDIA, who invest in data centers, who invest in AI services, because they all genuinely believe there's a real significant opportunity at the other end and are fighting for this very big prize. They are fueling each other's growth with internal capital derived from existing earnings.
But I have to ask, isn't that utopian thinking the exact same emotional mechanism that fueled the 2000 bubble? The idea that demand for internet services was fundamentally unlimited, that the rules had changed.
Is there a question?
What are the practical limitations to Q that the market might be missing?
That is the critical, sophisticated question that every investor should be asking. The difference today, I would argue, is that the utility is immediate, and tangible AI is already writing code, automating customer service, and generating measurable efficiency gains right now. In 2000, the profits were always 5 years away.
However, the immediate limitation to infinite Q might be human adoption or even structural bottlenecks beyond compute power. Are we training enough engineers? Can the power grid support this exponential growth in data centers?
Absolutely. The limitation might not be technical, but infrastructural or even regulatory. If governments suddenly impose severe restrictions on data usage or required transparency for AI models, that could slow down Q significantly, regardless of how cheap the compute P is.
Right.
The bulls, like Lafont, are assuming that external factors won't stifle the ability of businesses and individuals to absorb and utilize this cheap intelligence.
A constant risk. And even the most ardent bulls are watchful. Lafont noted that rapid increases in valuation can mean that belief in this infinite future is already priced in for publicly traded stocks.
He did.
He cited Oracle's recent stock chart volatility as an example, a huge rise followed by a pullback.
It's the constant market tension. You can believe in the underlying future, but the immediate public valuation can always outpace that reality.
But the key differentiator today.
The key differentiator is that the valuation isn't standing on thin air or on debt. It's standing on profit and cash flow. That makes the foundation significantly more solid, even if the structure wobbles occasionally, because the company financing the innovation is not in danger of going bankrupt if its stock price drops 20%.
That distinction, survival versus collapse, is vital.
Oh, yeah.
So this analysis provides a fascinating contrast in structural financial health, but there are always enduring lessons from history, regardless of how different the market architecture is today.
Always.
What did the dot-com disaster teach us that remains critically relevant for the investor looking at AI today?
Well, the sources emphasize that psychological discipline remains paramount. The first enduring lesson is the critical importance of proper due diligence. In 2000, investors were fixated on metrics like website traffic and eyeballs. Today, you must shift your focus entirely to the fundamental drivers of value: cash flow generation, demonstrated product-market fit, and sound business models. Chasing hype alone, whether it's the dot-com or the newest AI acronym, will always lead to trouble.
And the second lesson speaks directly to that emotional component of the bubble, the speculative fever.
Right. It's the need to exercise discipline against emotional expectation. Investors should, stop making investments based purely on unrealized potential in entities that have not yet proven their cash flow generating ability and long-term sustainability.
Okay.
If a company's valuation is based entirely on a hypothetical future where its cheap AI token enables infinite demand, you are speculating on expectation, which is the definition of bubble-driving behavior.
So even with the AI boom, the warning remains. Be highly wary of those smaller, private companies without a clear, near-term path to profitability, even if they have the most exciting technology.
Absolutely.
The fact that the system is structurally sound among the Mag 7 doesn't protect the smaller, speculative players.
Correct. The private market will still experience volatility and failures. They just won't destabilize the entire public market.
Yeah.
And the third lesson is a practical, technical one, but absolutely vital: a warning about risk and the beta coefficient.
For those navigating this high-growth environment, remind us why beta is so important and how it played out in 2000.
During the dot-com bubble, most tech stocks posted a high beta, meaning a coefficient greater than 1.
Right.
Beta measures a stock's volatility in relation to the overall market. A beta of 1 means the stock moves with market. A high beta stock, say 1.5 or 2, signals a high-risk stock that will fall much more significantly than the average market during a general downturn.
So if the broader S&P 500 drops 10%, a stock with a beta of 2 could drop 20%, amplifying your losses significantly.
Exactly. And while high beta offers massive gains during a boom, investors need to be acutely aware that they are taking disproportionate risk in the event of a market correction. The underlying warning about high beta stocks means that even if the foundation of the Mag 7 is sound, the risk profile of these volatile tech equities is designed to amplify pain during a general market correction.
That's a critical historical lesson that remains true today. If you are investing in a high-flying chip stock, you have to prepare for amplified downside risk.
You do.
And connecting this to the health of the giants, Bill Ford gives very specific advice to the learner, regardless of where they choose to invest, be it public or private.
He does. He emphasizes that understanding the incumbents is the new necessary form of due diligence. He says simply, you can't invest in the private market without an understanding of what Oracle, what Google, what Microsoft is doing.
So what does this all mean for the person trying to navigate this massive technological shift?
It means awareness of the incumbents, their cash flow, their debt-free status, and their investment decisions is essential because their strength is the bedrock upon which the entire AI economy is built.
So in summary, the current environment features genuine earnings and structural capital discipline, thanks to the private markets buffering early-stage valuation risk and the debt-free nature of the established tech giants. And that contrasts sharply with the 2000 environment of debt-fueled speculation and minimal, often non-existent fundamentals. So to quickly recap the two most significant differentiators that argue strongly for this time is different. First, the concentration of AI capital in cash-rich, profitable hyperscalers, which is a massive contrast to the minimal revenue startups of 2000.
Right.
And second, the structural shift of massive early-stage valuations into the less volatile private equity market, rather than the destabilizing IPO flood that characterized the dot-com bubble.
Those structural shifts in financial fundamentals are compelling arguments. But let's leave you with one final thought to ponder that builds on the unique economics we discussed.
If the 2000 bubble burst because the valuations were disconnected from traditional value metrics, price to earnings, revenue, and today's AI companies are basing their future value on the idea that the elasticity queue of what they can do with cheaper computing is infinite, that demand will never be satiated, what unexpected non-financial factors, other than traditional earnings pressure, could be the first sign that today's queue is not, in fact, boundless.
Interesting.
Consider infrastructure constraints, geopolitical shifts over compute access, or even cultural resistance to widespread AI adoption. What unseen ceiling exists for the supposedly infinite demand for intelligence? Something to mull over as you watch the headlines this week.
अगर आपको वीडियो पसंद आया हो तो लाइक, शेयर और सब्सक्राइब जरूर करें।